Hello, friends, and welcome. This is CA Rajiv D Khatlawala, author of the book How to Profit from Technical Analysis, which was published in the year 2008. And right now, almost after 12 years, we are in the second edition of this book after 10 reprints, more than 10 reprints now. Friends, this video is specifically to give you a understanding about how the stock markets work and what is the importance of psychology and discipline. Let me give you a small background. Recently, in one of my WhatsApp groups, I received a very interesting video clip from a CNBC video clip, which indicated the phenomenal gains that investors would have got by investing in the IPO, that is the initial public offering by Divis Laboratory. That time the price, the IPO was at 140 rupees per share, and it indicated that if you bought 1000 shares at that time, that is in 2003, your investment would have been around 1.4 lakh rupees. And after in the next 17 years, after almost many splits and bonuses, after 17 years, in the year 2020, that is as of right now, you would actually be holding 20,000 shares. So your original investment was 1,40,000 for 1,000 shares, and the company gave you, because of the split and bonus, it gave you additional shares, and that cumulative shares would have been today 20,000 shares. Now, at the current price of approximately 3,900, the value of that would be around 7.8 crores. Yes, there is no, I have not misspelled this. This is correct. 7.80 crores. It is a huge 557 times returns. Now, the question is, everybody, all investors would be awed by this thing. Yes, even I was. Wow, what a great return. What a phenomenal return. And these are the returns which are possible only in the stock markets and when you invest in such shares. But let me give you a different perspective. Now, what I will be discussing is more to do with this discipline and the psychology of an investor. So let us see what has been the price movement of Divis Laboratories since the year 2003, since it came into public. So what you are seeing on the screen here, friends, is 10th of, this is a weekly chart. So, it is a week ended 10th of March, 2003. This was the initial price. Now you are seeing a little lesser price. You are seeing a price of only 8.7 because these prices are adjusted for the split and the bonus. So there is a back calculation done by the software itself. Now let us try to understand the behavior of price during this 17 years. So from the March low, the starting point of around 9 rupees adjusted, 9 rupees, for your understanding, 9 rupees is an equivalent of 140 rupees. And that is how, the calculation is done. Now, you have seen the stock saw a rally from March 2003. There was quite a comfortable rally, and the prices went to a high of an adjusted price of around 100 rupees. Yes, so a 10 times return was available in almost 1 year, 1.5 years. Now, after that, let us try to understand the price behavior. What happened to the prices? Now, after that, friends, the prices started correcting. And the stock which had reached an adjusted figure of 102 slowly and steadily in the next almost, we can say almost 1 year plus, 1 year and 3 months or so. In April 2005, the price fell to a level of 45 rupees. Yes. So from 100, the prices slowly and steadily fell to 45 rupees. Now, this, what you are seeing on the screen, friends, is what is called in technical analysis, it is called the retracement. Retracement would mean what is the correction in the price. So correction would be from this low of 10 rupees till the high of 100 rupees, the prices corrected, that is, they retraced around 61.8%. So there was, we can say in technical language, we say there is a correction of 61.8%, right? There is a 61.8% retracement. Now, after touching this 45 rupees level, the prices started again moving up. Now, please remember, this was in the year 2005, April. Now, after that, there was a rise in prices. There was still a lot of fluctuation. The prices tested 100 rupees again. They fell back to a level of 55 again. So from that 100 rupees, it again went down by almost 50%. After that, now you saw a real rally again. And the second leg of this entire rise came from this low, which we just saw of 55 rupees in the year 2006. There was a comfortable rally till the time 2007 December. Now that price, it went to a high of 482. Yes. So from 55, in the next almost 1.5 to 2 years, it went to 482. Now from there, there was again a correction. And that correction from 482, the prices slowly and steadily, they tested a low of 188. So from 480, it went to 188. From that level again, friends, there was another set of a rally. So I'll just compress the chart so that you can observe that rally again. So from this 188 figure, now you're seeing it here, there was another rally, and that rally took us to a high of 1300. So from almost 180, 190 levels, it rallied to 1300. Again, the price saw a huge correction. And from 1300, we again saw a level of 500. Yes, friends, from 1300, the prices went back to 500. Now, subsequently, there is a, after that 500 fall in 2017, now there is the current rise is still on. And we touched, this is as of January 4th, the date of this recording. And from that lows of around 500, consistently the prices have been rising. Of course, there has been some intermediate corrections you are observing here. And the prices touched 3,900. Now the question for you, friends, is everybody of us, we want great returns from the stock markets. Everybody was very happy when I showed the video of CNBC. Everybody was very happy that, oh, wow, 1.4 lakhs going to 7 crores. Everybody wants this type of a return. But the key question, friends, here is, will you as an investor be able to absorb the huge volatility which I just discussed? Can you absorb a price? Can you see the price of your stock, which was quoting at 1300, crashing to 500 and still remain in the stock? Now that is where the discipline in stock market investing comes in. Not only the discipline, but I would like to add here, friends, that this gain which the video talked about, the gain which the CNBC video talked about, that 1.4 lakh invested goes on to almost a 550 times return of 7.8 crores. Now that, please believe me friends, that is a theoretical. There is a theoretical return. Not many investors, hardly 1 or 2% of the investors would have actually got this sort of a return. Why? Because we have, as I have just shown you on the charts, there are a lot of fluctuations happening in the market, and if you are able to absorb those fluctuations, only and only then can you get these sort of returns. So do not get carried away when you see such videos. My request to you all is that please also think about the intermediate corrections which can happen and will happen in the stock markets, and if you are able to absorb those, only and only then can you get these sort of returns. So friends, I hope this video is especially, in fact, I would request that new investors who have joined the markets in the last couple of years or last 3-4 years, please watch this video and try to understand and think about it, of what the long-term returns in the markets means. It is not a straight one way up. There are a lot of fluctuations, and your value of the holdings can go down more than 60-70% in the intermediate corrections. So I hope this video will give you some food for thought, and it will give you a good thinking ideas about the returns in the stock markets. So thank you very much friends for listening to this video, and I hope if you have any comments, definitely you can give your comments below this video. Thank you very much.